guys, welcome back. In today's video, we are talking about Citadel being fined by CAT, lending out too many shares, the FTD issues, and many more in this video. First, we're taking a look at this. So your fine for failing to report tens of billions of trades is 0.0001% of your revenue. Please don't do this again. Now, obviously, this is sarcasm, but I wanted to talk about this particular fine and what it means in general. Now, what we have seen is, of course, another fine for Citadel. Now, to make it understandable, Citadel basically paid 0.000000238 per error. So if $1 million is the fine for 42 billion misreported orders by Citadel, you can calculate the fine per order by dividing the total fine by the total number of misreported orders. And that obviously gives us around this number. And now this is something that's obviously extremely crazy, but what I want to talk about here is in terms of what this all came from. Now you can see here, from the start of its consolidated audit trail, CAT reporting obligation on June 22nd, 2020 through August 28th, 2024, Citadel Securities failed to timely and or accurately report tens of billions of equity and options order events. Now, this is what we talked about with the implementation of the CAT system. We've talked about the pros and cons, and it is exactly highlighted within this post. So what we have is obviously the CAT system able to finally catch out, who's doing the bad things. It's able to see who's manipulating, who's inaccurately giving out data. In this case, of course, Citadel. But one of the things that we've always said in terms about CAT will bring us the transparency that we want to see, in which it is, but it will not bring in the regulation that we want because the fine it's giving, it's so tiny. How could Citadel possibly be hurt or have any impact by paying, 0.00002 cents per order? This is essentially a cost of business. They're obviously making way more money with these reported orders, and they only have to pay a small percentage of that profit just to get rid of it. And so this is obviously ridiculous, but it's what we talked about in terms of understanding. We are seeing the CAT system working. We are seeing the CAT system bring transparency. We are seeing the CAT system bringing in, the regulations that we wanted in terms of catching out these firms and fining these firms. What we are not happy with is obviously the extent, the impact of these fines, as it doesn't have any impact. It doesn't prevent them from obviously making these mistakes in the future. But when you partner that with what we obviously said going into January, as we see Trump in an administration, as we see the SEC having a new, of course, office, a new chairman, we're obviously very likely to be seeing a much harsher fine, a much harsher, penalties for these firms. And so what is good is knowing the fact that the CAT system is working, that the CAT system is catching out these very firms who have been manipulating and reporting inaccurate data. And now the next step for us is obviously for these penalties, for these consequences to actually mean something where it actually then prevents them firms from making these, mistakes, from making these plays that are obviously exploiting and manipulating the overall market, but also the retail investors. And so this is what we talked about in terms of understanding. I do think the CAT system is working, but I just don't think it is working the way we intended it to because the fine is just so little. Now, another thing is talking about yesterday. Something that we talked about was obviously the issue with Virtue, is the issue with IBKR. And you can see IBKR was one of the brokerages that removed their customers' ability to buy a dozen security as the code didn't hold enough shares of stock to prevent themselves from becoming insolvent. This included stocks like GameStop, AMC, kohrs, and more. They lent out too many shares to hedge funds and will have to buy the shares back at whatever price the CEO said. So this is what we said in terms of understanding how short and brokerages are all starting to panic because they understand, what is at risk right now. Obviously, the short, they know that if they hold on to these shares, they will obviously have to buy it back at thousands of dollars, at $10,000. And the brokers understand that because they're delivering shares that don't even exist, they have to make sure it's actually appearing in the books. And so they also have to buy these shares at thousands of dollars, wherever it's 1,000, 5,000, or 10,000. And yesterday, what we obviously talked about is in terms of understanding how IBKR obviously said that they are scared that the whole market is overextended, that when it crashes, they don't want to be holding the bag because that's where margin calls will come. And so, this is what we are witnessing right now. And the very fact that they had to do this in the past before knows and shows us that they are obviously worried, and it's very likely they're going to be doing this in the future as well when we see the situation become relevant again. And so all these preparations that we're seeing these firms do right now is a very clear indication of what's to come, of what's at stake, and especially what they are scared of. And so, when we take a look at what the overall market is doing, about how it's overextending, and then we take a look at how AMC and GME is performing, we can definitely come to an understanding of how shorts continuously to suppress AMC whilst trying to also, whether it's the hedge positions, whether it's to try and slowly get out or protect themselves, these are all things that they are trying to do right now, all while still trying to crash AMC down to zero if they possibly can. But of course, we know that's not the case. And the big reason for this is because you can see this. Bears took advantage of the dirt cheap manipulated price of AMC. If they think apes are selling, they're very wrong. So we're seeing this particular user who bought 5,000 shares of AMC at $3.99. Now, this is just a reflection of pretty much what's happening in the market. Now, $5,000, you may consider it small, you may consider it big, obviously depending on how big your cash is. But the reason why I mentioned this is because he isn't the only person who's buying. And I think he speaks for a big part of the community where when they see these opportunities, when they see AMC at a dirt cheap price, and they understand it's not real price reflection, when they understand that the price discovery is not yet there for AMC, and that the fundamentals of AMC is only going to get bigger and bigger, the investment potential for AMC as it sees a lower price is only going to increase in terms of the ROI, then we are seeing everyone actually buying into AMC. And so whilst the hedge funds think by manipulating and suppressing the price down, it's going to make people leave and sell their shares, it's actually in fact doing the very opposite. Now, this is actually a worrying problem for the hedge funds because what they think is making the retail sell is actually making the retail buy. And because the retail are buying, that they have to create more synthetic shares to actually fill up the books, to fill up the orders. And by creating more synthetic shares, it's obviously costing them more money. It's making the situation even bigger. It's eating into their leverage. And again, the most important factor is that when they have to cover, they have to cover all of these synthetics that they have created. And so you can see why the shorts are starting to panic every single day, as the more, in terms of the lower the price they get, the more people are buying. And then the more synthetics they have to buy and create and sell off. And that's what they are worried about. Now, another thing you can see, massive failure to deliver situation involving the iShares Russell 2000, which is reportedly linked to approximately 1.4 million shares of GameStop. Traders are concerned about the unresolved FTDs, particularly as significant deadline approaches, with some suggesting that IWM's holdings may not directly include GME shares. Now, we've actually talked about this in the past before. We talked about how this was actually a way for them to prolong the whole situation with FTDs, with AMC, with GME. And, this is something that we've seen with data that we obviously covered on this channel. And now we're seeing this happen again. And what you'll find is that recently we are seeing many issues about, like we talked about, overextended equities, meaning that equities are of course overvalued. We're seeing the reverse repo, which again, another way of showing liquidity issues. And in general, we are just seeing massive reports of liquidity problems. Now, these are all of course linked to what's happening in the market. The very fact we are seeing FTD failures, the FTD issues, is obviously showing they are unable to settle shares. And the very fact they're unable to settle shares is showing that, firstly, the difficulty to locate shares, and secondly, the liquidity for them to be, doing what they've done in the past. Now, it's not a surprise that there are FTD problems. When you take a look at this, massive whale purchase on GME, nearly $3 million for 89,000 shares hit lit market. And this is what we're seeing right now. More and more people are buying into AMC. More and more people are buying into GME. Now, like we talked about earlier, when people are buying into GME, when people are buying into AMC, the fact that all the shares have already been bought up, yet we're still seeing these massive orders, means that they have to create synthetics. And this is precisely why we're seeing the FTD issues happening, Because whilst they think that people are going to sell their shares, people are doing the opposite. And so they have to create these synthetics. And that obviously leads to the FTD issues. And that's exactly what's happening right now. Now, this is obviously a very bullish sentiment as we're seeing people buying more into AMC, buying more into GME, and you can see it reflecting on the GME price chart recently. But this is also a showcase of the lack of liquidity, as we see that now they can't fill up to these orders. Before, we've seen people buy multiple shares of GME and AMC and at a bigger volume, but yet we didn't see that big of FTD issues. But now we are, and that's obviously a showcase of the lack of capital for these hedge funds. You guys, thanks for watching. I'll catch you guys next time.